I feel so good that I have focused so much on gold and silver with a little bit of cryptocurrencies, with everything that is going on in the world right now. I can't imagine the anxiety that I would feel if I was just in stocks and real estate right now. Hi, this is Mike Maloney with Ronnie Stoefferle again of Incrementum AG with the In Gold We Trust report. And we've been going over the chart book. And this segment is going to be on gold versus stocks, sort of. So, Ronnie, how are you doing?
Very good. How are you, Mike?
Great. On page 21, you've got the gold S&P 500 ratio going back to 2008. You've got a couple of ellipses here. Tell us what you see in this chart.
Well, Mike, we use ratio charts quite a lot because, nowadays with, I would say, very, very aggressive central bank policy, I think prices don't give you as much information anymore like a couple of decades ago. But I think that having a look at relative prices, at ratio charts, it's really important, especially when it comes to asset rotations. Now, what you can see on this chart is the ratio between gold and the S&P 500. And you can see that equities basically started outperforming gold in end of 2011. Since then, it was the better choice on a relative basis to hold equities and not gold. So the stock market was outperforming gold. Then, the momentum decreased. And actually in fourth quarter 2018, if you remember back then, this was the time when basically every asset class was falling. It was really a very volatile a quarter. Stocks were down big time. There was stress in the real estate markets, in the corporate bond market. And this was also the time when the Federal Reserve started its big U-turn. Because back then everybody thought, okay, interest rates will rise forever. So this was also the time when this ratio started reversing and actually gold started outperforming the equity market. And yet, as you can see on this chart, those trends normally go for extended periods. So I think we're quite at the beginning of this trend where gold outperforms stocks. And I think, we shouldn't underestimate that there's lots of momentum players, CTAs, managed futures, and so on that also see those relationships that are changing now. So I think this will become also some sort of a self-fulfilling prophecy. And as I've said, this train just started moving.
Yeah, I think gold isn't just going to outperform stocks. I think it's going to outperform everything with the exception of silver. And possibly some cryptocurrencies. I just see, but the cryptocurrencies to me are much more of a gamble. I just see gold as this sure thing because of its 5,000-year history of doing this. So let's move on to the next one where you've got gold in local currency and domestic stock indexes. So you've got gold versus stocks measured in each currency. Am I correct?
Yes.
Okay, tell us about this.
Well, actually, we always said that gold stabilizes your portfolio, and gold did a tremendous job this year. It is a fantastic defender of your portfolio, and this chart was updated on 24th of September. So those numbers are not that impressive anymore. Like, for example, in May or in June, because back then price of gold was up big time, but equity markets were still severely depressed. But still, you can see here that gold outperformed equity markets all over the globe. And for some local currencies or some markets like Australia, where Australian stocks are still down 14%, while gold in Aussie dollar terms is up 22%. That's a pretty big outperformance. In Russia, for example, gold in Russian ruble up 53%, while the Russian stocks are down 4%. So I think it's really important to tell people that if you have a large equity exposure, you can hedge it also with gold. And we did in our last In Gold We Trust report lots of calculations that show actually gold does tremendously well in the course of a recession. And we saw that this year, big time. It does well when stocks are collapsing. And it does really well in times of inflation, and especially when real interest rates are falling.
Yes. And I see a very risky time ahead of us here. I feel so good that I have focused so much on gold and silver with a little bit of cryptocurrencies, with everything that is going on in the world right now. I can't imagine the anxiety that I would feel if I was just in stocks and real estate right now. The anxiety, I don't have that level of anxiety. I'm confident that I will be okay through all of this. The next
Well,
chart,
Mike, sorry, did you know that real estate in German, it is called Betongold? Betongold means concrete gold.
oh,
So people, there are real estate bubbles all over here in Europe. So
yeah.
people say they really compare it to gold, but my
Yeah,
take
well,
would be, well,
they're not going to be comparing it to gold in 2 or 3 years. In two or
yeah.
three years, back during the real estate bubble here, people were jumping into real estate, and I would tell them what was going on, that it was in a bubble, and they said, "But real estate always goes up. You can't get hurt with real estate; it always goes up." Well, they learned a big
Until
lesson.
it doesn't.
That's right,
Yeah.
until it doesn't. I was on. There's a website here called Zillow that is listings of homes for sale. And I went on there for some reason. I had a couple of properties at the beach here, and you could almost see them out my window. They were sort of over there, and right on the beach, 3 apartments that I owned, or condos, and I just sold them. And I feel so good that I got out of them. And I went on Zillow to check some things, and I saw that there was a saved home in there. Well, it turns out that back in like 2013, when I was on Zillow, I guess I had saved a home. I clicked on it, and it took me to the Malibu Mountains in California. I was horrified at the number of homes that are for sale. And the number of homes in Malibu that are like $100 million, $150 million. It's like triple the normal number of homes that are for sale, and there's no possibility that the market can absorb this. The demand just isn't there, so the prices have to fall. The bubble is popping. The pin is right now piercing that bubble, and it's all of these people that have been squeezed because of the lockdowns that are trying to get out and move to cash and try and save some of their portfolio. So let's move on to the next chart, page 23, the S&P/gold ratio. And you have the bull and bear markets here marked out the way I measure them. This is the way I measure a bull and bear market, and I call this wealth cycles. When you're measuring it not with a fiat currency that you can't trust. My friend Chris Martenson calls fiat currencies skydivers. They're all they're falling at different rates, but they're all skydiving compared to real assets like gold. And, I'm currently in the process of buying some farmland, because farmland, I don't believe, is in a bubble. Anyway, these ratio charts reveal so much, and you have these things marked out with some red divisions here. Tell us about these, and do you see these as the shift from bull to bear market, or do you really prefer measuring things in dollars and using the 20% standard?
Well, I think it's best if you get a confirmation from both views, and I think what markets have taught me is that the bigger your toolbox is, and the better you understand those tools, the bigger your success is. So we use fundamental analysis. We have the understanding of the monetary system, which is very much influenced by the Austrian School of Economics, but that doesn't help you with your trading decisions. So we use charts. We use ratio charts. We use
I'm sorry.
for example, sentiment indicators for a shorter term trading as well, just to get a feeling for the general view. Now, what we're seeing here on this chart is those very long periods of risk on, risk off that can also be measured via the S&P 500 to gold ratio. And from my point of view, we're pretty much in the dollar bearish camp, and I think that if you believe that inflation will become a concern, then I think you are necessarily also bearish on the US dollar. And I think that, as I've said, inflation will probably be the big driver for financial markets going forward. Now, Mike, I don't know if you knew that the average investment advisor nowadays is 54 years old. So that means they never in their professional career, they never experienced a highly inflationary market. So I think that if inflation should become a concern, this is our base case, I think many people will be puzzled because they have never experienced it. And the interesting thing is, if you talk to people from emerging markets, from Turkey, from Brazil, for example, they know how it feels to invest in a highly inflationary environment. So if you talk to those people about gold, they've got a completely different understanding, and for them gold is it's just the much more stable currency compared to the Brazilian real or the Turkish lira. And I think that many people cannot believe, because the dollar is the world leading currency and the strongest economy and stuff like that, and the strongest military, nobody really sees a big bear market for the US dollar happening. And from my point of view, it is something that we will experience in this decade. And actually, a weak dollar would be, for the whole world, would probably solve a lot of problems. And therefore, I think that we should prepare for an inflationary environment going forward, but also for a weak dollar.
Yeah, a weak dollar means a higher gold price too. So, yeah, when you talk about having a bigger toolbox, I absolutely agree with that. But at the same time, I don't trust measuring things with fiat currencies anymore. And so measuring things this way, I see as a much more reliable indicator. Although 2010 to 2020, I didn't call that. It is a risk-on environment for traders. But I still see this as one big bull market. It's very difficult to trade that middle and dump your gold in 2011 and go short maybe, and then buy back in December of 2015. That's very difficult. Some of the things I want to point out to the viewers here is in this chart from 1950 to 1970, gold is fixed. It's $35 an ounce. So this is stocks outperforming gold. And then stocks in 1966, the Dow, for instance, bumped the Dow and the S&P are almost, when you do a correlation on them, they're almost the same. If you go back to the year 1900 and do a correlation, they track each other very well. So I use either one for a proxy for stocks. But in 1966, the Dow bumped its head on 1,000 points, went sideways until 1980 or 82. In the meantime, in your chart here, you can see that gold takes off from 71 and to 74, makes that big plunge. Then there's a mid-cycle correction where gold fell from just under 200 bucks back to 103, and the stock market had a big plunge that ended in 74, at the end of 74. From 74 to, I think it was August of 76, you see so the last day of first day of 1975 to August of 76, there's that rebound in the middle of the 70s where the cycle goes up. Gold is going down, stocks are going up. And then it continues down to 1980. Like I said, I don't find those things tradable where you can count on it. Somebody else may have the talent to do it. I certainly don't. But when you measure things like this, you can tell when something is truly overvalued and it's time to get out of stocks and into gold, and when it's undervalued and time to get out of gold and back into stocks. So I love this chart. Now, you were talking a lot about the US dollar, and the next chart is the US dollar index, chart number 20, page number 24 in your chart book. And so you're talking about the US dollar losing value over time. And when you're talking about it, I think you were talking about it against other fiat currencies, but they're all falling too. So it's losing most of its value against gold. But tell us about the US dollar index here.
Well, it's a trade-weighted US dollar index, so against a basket of currencies. And what we wanted to show here, as well as those downtrends, those bear markets, they're happening really on a long-term scale, and if this trend really starts, it can go for many years. And from our point of view, such a new downtrend, a new bear market has started recently, and I think that as I said previously, a couple of basically 2 years ago, the rate differential was really the main reason why so many people were still extremely bullish the US dollar. Now we don't have this rate differential anymore, and you can see on this chart, I think is that it's really all about long-term trends. And once we are in a dollar bear market, this can go on for many years, and I think it has just started.
Yeah, it looks like 84 or 85 to 2000. So yeah, you're talking that each one of these cycles is a very long cycle. And then I think did you want to talk about the next chart, gold in US dollars and gold / S&P, or do you want to move on?
I think what's interesting to see is also slide 28. So this is actually the purchasing power of currencies.
Yeah, these are the skydivers.
Yes. But I never went skydiving. I want to go, but I've heard that it's good to bring a parachute.
Yeah. I've done it a
helps.
couple of times, but it's I actually did not enjoy it that much. It is good to bring a parachute. It's just that these fiat currencies don't realize that when they pull the ripcord, it's going to disconnect their parachute. They've got the parachute right now. They're falling slowly. There's going to come a day where they fall very fast. But look at these ratios. You've gone from you've indexed them at 100. And when they fall to 10, that's a 90% loss, right? Yeah. So tell us about it a little bit more, the different currencies. I see the Swiss franc has done the best as far as maintaining purchasing power, but
why did the Swiss franc do best?
Well, I don't know. You tell me.
Probably because they were basically on a gold standard up until I think end of the 1990s, and still the Swiss National Bank owns. I don't remember the exact number. I think it was roughly 900 tons of gold. So it is a very stable currency. I mean, it used to be one of the very few safe haven currencies, but now I think the balance sheet of the Swiss National Bank looks a bit like the portfolio of a hedge fund. So
Yes.
it's a bit of a misinterpretation of the role of a central bank. But anyways. I think what you can see here is really fascinating, and this confirms our view that it's not the price of gold that is rising, that it's rather the purchasing power of those currencies that is falling. And as you've said, it can happen pretty quickly, like in the 1970s, and then we saw this rebound basically for 2 decades. And I think the main reason is people ask me, well, 1980s and 1990s were horrible for gold investors. And say, well, yes, but the main reason was that we had huge opportunity costs. So actually in the 1980s and 1990s, we had basically all the time, 2 decades, positive real rates. So it made sense to keep your money on your savings account. Over here in Austria, I got 7% on my first savings account. So this is, of course, a competitor to gold that doesn't pay any interest. And when I started writing about gold, people said, yeah, but gold doesn't pay any interest. And I said, yeah, it doesn't have to pay any interest. But nowadays, this argument um, is basically not existing anymore, because you don't get any interest in any currency, or you can go, of course, into a highly risky currency and then get 3 or 4%. Yeah, but then inflation rates in this currency will probably also be quite high. So, and this is also the main reason why I'm so confident regarding gold, because we just cannot afford positive real rates over the next couple of years. So there won't be any opportunity costs for holding gold. And I think this is really the foundation of this bull market.
Okay. I absolutely agree with you. We're going to wrap up this segment. And I want to thank you very much for your analysis on these charts. It's always great talking with you and getting your point of view. So thanks a lot.
Thank you very much, Mike. Thank you.